everyone. Welcome to Beyond Borders by MSA Novo. For those that don't know, MSA Novo is one of the most prominent global institutional funds systematically investing in emerging technology markets. And with Beyond Borders, we bring you the world's leading founders, technology disruptors, and prominent leaders within the entrepreneurial ecosystem. And I'm super excited to have here with me today Hisham Qasim, an extension of the MSA team, as well as one of the most prominent venture capital lawyers in the Middle East. Hisham, thank you so much for being here with us today.
Thank you for having me.
I'd love to start with a brief introduction. You and your firm represent the region's leading VCs, banks, private equity firms. So I feel like lawyer is a bit of a boring word for you. So I'd like you to tell me, in your words, explain what you do and your role.
Okay, thank you. Thank you for having us. So our role, yes, we are a law firm and we work with a few VCs and private equity firms. Our main role is sort of as problem solvers for VC funds and startups. We also work with startups. I think that's mainly what we do, is work with clients to help them achieve certain objectives, and the law is usually just the means to that end. I want to register a fund, I want to raise money. How do I do that legally? But there's always an ultimate business goal. So yeah, I think that's what summarizes what we do.
So let's talk a bit about the early days of establishing a venture fund. So venture funding is relatively new in the Middle East when compared to the Western world. And the number of investors over the years in the Middle East has really exponentially grown. So back in the 2000s, we saw about 1,700 venture funds in the United States, and there were only 6 in the Middle East, primarily all in the United Arab Emirates, right? And then you go a decade later, 2010, and that has grown to 31 funds in the Middle East. And then the first accelerator in the region was actually founded right here in Jordan in 2010. And then it really was a domino effect after that. Today, I think the number is threefold. So tell us a bit about that transformative decade that really transformed venture funding in the MENA, and the process and evolution of how venture funds were actually able to surpass legislation and be able to register as venture capital funds.
So yes, so in the early 2000s, we had, like you said, 5-6 funds, and then by now we've reached about 40 to 50 funds. The reason why we have this 4 or 5-fold increase is greater government backing. There's a lot more money going into this space. In terms of where the funds are incorporated, still very few of them are registered in the Middle East. Some are being incorporated in ADGM, which is a relatively new jurisdiction. It's 10, 15 years old. The vast majority of funds that operate in the Middle East are registered in Cayman, Netherlands, these sort of well-known fund jurisdictions. I think the governments that are now investing in these funds are okay investing in non-Saudi or non-Jordanian funds, because those laws just don't exist yet in the Middle East.
Okay, and where do you see that in the next few years? Do you see the Middle East governments all coming together, creating a unified legislation for these venture funds to establish themselves and promote more fund managers to come in? Or do you see more international investors coming in and just investing out of foreign pockets?
It would be great if everyone came together and created unified legislation. I don't know if that will happen. A big reason why we go to countries like Cayman or the US, there's a very long history of establishing funds there. So not every question, but a lot of questions are already answered. So we kind of know what to expect. The main issue with creating something new, especially in the legal field, is there's no history, there's no precedence for what's going to happen. So I think what we have now is probably fine. Do see some consolidation. We probably have too many funds, right? I don't know if we need 50. So as those funds get bigger, they can go to more expensive jurisdictions like the Netherlands or Luxembourg that have higher and higher KYC requirements. The main issue now is that many of the funds are small, like 10, 15, 20 million, and the jurisdictions that house funds don't assume that fund size. They assume funds of 100, 200 million, so the costs are usually much higher. But I think as we consolidate, that'll be less of an issue.
And like you said, I mean, years ago, fund sizes would be 500K early stage investing, 1 million, and now you see much bigger fund sizes coming in. You see a lot of foreign investment coming in and also trying to set up in these local jurisdictions like ADGM. So let's talk a bit about the common trends and patterns happening in MENA fundraising. So the Middle East has been very resilient when it comes to all of the geopolitical situations and economic downturns happening around the world. And somehow, although a lot of these issues are centered in the Middle East, somehow the Middle East funding scene has been very resilient. And we've seen that the Middle East has received the most funding last year. So can you shed a bit more light on what really makes this resilient ecosystem in the Middle East?
Yes, the governments in the Middle East have decided they need to grow this sector. So a lot of funds are receiving money from state-owned or state-backed fund of funds. So it's less driven by market dynamics, more political dynamics. Jordan has a very young population. We need X number of jobs to be created in 5 years. So there's a push by all states in MENA region to create jobs. And I think that partly explains why we see this tremendous growth and this resilience. On the flip side, because we have very young populations, the same in Jordan, Lebanon, Saudi, a lot of opportunities to invest in. You have highly educated, motivated people, I think mostly under 35. The traditional route of getting a job is no longer available or no longer as appealing. Now, I think over the last 10 years, starting a company has become a lot more viable and socially acceptable.
Well, let's create a little bit of focus now. So when it comes to funding, what do you think about Saudi Arabia? So Saudi has really become the buzz of the region over the past 2 years with Vision 2030 coming in. So across international partnerships, technology development, funding, I mean, Saudi and China inked investment deals worth up to 25 billion last year, which MSA was also played a very big part in as well. Saudi ranked first across the region when it comes to startup funding for the first time ever recorded in history. And they had a 33% year-on-year growth. And the funding in Saudi Arabia made up 52% of MENA's total venture funding and capital deployed. I mean, it was mainly due to mega deals like Tamara, Flowered, and also MSA portfolio companies like Tabi and Sari. So as someone operating in this space and managing these funds internally, how do you see Saudi coming into play when it comes to this?
Right. So I think the best thing about Saudi is that most of the funding is going towards Saudi founders, or if they're not all Saudi founders, some of the founders are Saudi. The issue with other places in the GCC is most of the founders aren't from that country, so they sort of attract people from around the world to register there and live there. But investing in people that are from the same country, you get that sort of cycle. So the venture funds are investing in Saudi-owned companies, and then those people live there and they spend their money there. So it creates that cycle, I think.
What certain incentives are you seeing internally that are attracting this, first of all, Arab diaspora to go into Saudi, as well as non-Saudi founders building companies in Saudi?
I think because it's a very big market, it's open. there are a lot of Saudis. So if I wanted to open a company in Saudi, I could feasibly find a Saudi partner in my field because I think the population is about 25 million versus other countries in the GCC like Qatar, Bahrain, where there's only a few 100,000. It's harder, it's a smaller pool. But I think since Saudi is such a large market, it's much more welcoming and accepting of outside founders.
Okay. So let's talk a bit about fundraising. And in your paper, From Seed to Success, you really shed light on the evolution of Series A fundraising and understanding it and the misconceptions that we also have, because Series A is really different when it comes from region to region or even country to country. And it is really the awkward stage of a startup. So you would say it's the puberty stage of a startup, of when it actually matures. And you mentioned in your paper that at the Series A stage, most of these companies tend to mature, stabilize, adopt more financial controls, create boards. So why does it happen at this stage and not before? Why aren't these controls adopted when the company is first launched?
Because when these startups first begin, no one knows if they're going to work or not, right? You don't know if the product is going to work. You don't know if the founders are going to stick around. You don't know if there's product market fit. There's a bunch. It's much more likely that they're going to fail. So no one really bothers putting in these controls. You put a little bit of controls, a board. Even the type of investment is a convertible note, so there's really no one on your cap table. And then at some point, everyone starts saying, well, I think this company is not going anywhere. So it's generated enough revenue, it has enough traction, there's enough of a history that we can actually put a price on it. Before then, the price of the startup is really up to who you're talking to. But at Series A, people say there's a higher likelihood of this succeeding than failing. Before then, it's the exact opposite. At that point, you have a lot more money coming in, usually when the first VCs or big VCs, right? The first checks. So you need a board, and you need an ESOP plan, and that's usually when you hire a CFO and an HR person. So it's going from adolescence to adulthood.
Okay. I want to talk a bit about the failure rate a bit, because you also mentioned that failure tends to decrease when companies begin raising Series A. And I want to speak about specific examples. So you see a lot of second and third time founders and serial entrepreneurs establishing their companies, and they don't start with seed funding. So they jump from seed to Series A, and there's no in between. The model isn't really proven yet, but people or investors are investing in that founder rather than the company. So I want to hear your thoughts a bit about that. And then also tell me a bit about how Series A funding differs from the Middle East to the States. So when we say Series A, it can mean 2 million fund size in the Middle East, but it can also mean 200 million in North America. So I'd like to maybe understand the difference between these two.
I mean, the Middle East, this is much newer industry. In the US, the modern version really took off in the 60s, 60s. So they've got 50, 60 years ahead of us. So I don't think yes, in the US, the dollar amounts are much higher than they are here. Here, you can have a Series A, or what people call Series A, for a few million. But what matters more is the decision that investors make, that I think you're more likely going to succeed than you are to fail. So the dollar amount, I think, is more about where we are. We happen to be in the Middle East, costs are lower, so you don't need as much, and the market is much smaller. But that's sort of the signal. That's what it is. That's what the Series A signals to everyone else, is that I'm probably going to make it. And for founders, what I like most about this industry is that it's very people focused. Founders are very optimistic. They want to change the world with their product. So a lot of VC investing is really investing in the people. I know there are two schools of thought. You invest in the people, you invest in the idea. I'm in the people.
And I think that's very important. I mean, as a VC fund that primarily invests in emerging markets, we really see that entrepreneurship arises from necessity in emerging markets rather than, I mean, we have the dry powder, let's start a fund because this is going to be the next big thing. And you see most successful scale-ups, I would say, in emerging markets, whether it's Latin America, Sub-Saharan Africa, Southeast Asia, or the Middle East, really come from a gap that has been either underdeveloped or addressed from a government, or either something that you have a masses demanding when it comes to micropayments and payment accessibility in banking. So, I mean, definitely valid. Entrepreneurship does rise out of necessity here, and you find hungry founders trying to achieve that. So tell me a bit more about the duration of closing Series A. So we see that whether it's bootstrapping or smaller fund sizes, whether it's seeds, pre-Series A even, it's much easier to close these rounds. When it comes to Series A, A+, Series B, it becomes such a longer and tedious process. So what is the reason for that?
So I think the longest round to close is your Series A, because before then you're raising on convertible notes. Those are easy, very light due diligence. Documentation is much shorter. In the US, closing a Series A round takes about a month to 2 months. In the Middle East, anywhere from 6 to 12 months. And the reason is we don't have a standard set of Series A docs. So in the US, everyone follows this exact same template for like 40 years. Here we have a UK system, we have a US system, and I think the Saudis are trying to create their own system. So not everyone knows what set they're going to use or what the standard is. That could explain why it takes much, much longer.
But why is it different than closing a pre-Series A or a seed round? Is it the ticket sizes? Is it the equity? Is it the valuations?
It's a priced round. So we have to create a shareholder agreement, memorandum of association. It's just the documentation required goes from like 10 pages to like 200 pages. And this is also the first time VCs do real due diligence. I mean, not they do it, just very in-depth, let's say in-depth due diligence and financial due diligence. And this is when they start flagging things for the founder. You know, we let you get away with doing X. You can't do that anymore. So a lot of funds will say, well, I can't invest till you fix this tax problem first, or you pay off Social Security. That's actually what takes the most amount of time. After Series A, it actually becomes pretty easy because you've gone through that big jump. You have a CFO and HR. You file all your paperwork on time. You have a legal department. You know, it's making that jump.
And I think that goes back to the point where you said when companies reach Series A, that's when they tend to formalize all of their internal operations and financial controls. What about the number of Series A investors? So you say in your paper that the number of investors has increased faster than the number of Series A rounds. But we've also seen that when it comes to the availability of investors for larger funding rounds. So tell me your thoughts a bit about those two.
So I think the venture space is getting crowded, more and more crowded with more investors. I think there are more investors coming in than there are startups, like the supply and demand. So I think there's an oversupply of investors and an undersupply of opportunities, not just in the Middle East, probably globally. It's becoming much more normal normal asset class for regular people to invest in. It used to be something that only billionaires invested in, but now I think it's sort of a doctor with a couple of million can be an angel and start investing in venture.
Let's speak about valuations. I think this is a very sensitive topic for founders, for VCs and what they expect. So when we look at valuations, we see that in Series A, the equity sold per Series A is much less than earlier stages. So can you shed light a bit more about the study that you've done over the last year and the reason this really happens with companies?
So most of the data is US centric, just because they have it. We don't have the data yet. And in the early 2000s, companies sold about 40% of their equity in a Series A round. Now that's closer to 20. The round sizes have gotten bigger, so it means the valuations have skyrocketed. So they're raising larger rounds, but selling less. I think in the paper we said the valuations have doubled or almost tripled. And I think that's from the overcrowding. We're seeing a lot of investors going into the space and probably driving up valuations. But like any investment, yes, founders want higher and higher valuations, but if it's too high and you can't really justify it, you're sort of shooting yourself in the foot for the next round. Same thing for the investor. If it's too low, you're sort of signaling to future investors, maybe you're not the best VC to work with, maybe you took advantage, maybe you don't know how to price. So the key to venture investing is sort of finding the middle ground that's optimal for both parties. Yeah.
And especially in the Middle East, and when we look at younger markets, when it comes, or I'd say smaller markets when it comes to VC and entrepreneurial ecosystem. So like Jordan, Lebanon, we see that a lot of the companies, once they reach or once they're prepared to raise for their Series A or pre-Series A, they decide to move to the GCC, so the UAE or Saudi Arabia. So does location have a price tag when it comes to valuations? Because when you look at, for example, a gaming company that's established in Jordan, if it migrates to Saudi Arabia and set up shop there with the same exact operations or model, the valuations tend to be higher. So tell us a bit more about how multiples are influenced here.
Right. So it's still, location still matters even after COVID. So the idea is if you're in Lebanon or Jordan, smaller market, less reach, less access to capital. Once you move to a larger country like Saudi, you're in a much bigger market, access to more investors, customers. So the valuation does go up. You see the same thing in the US. The startups in the middle of the country, Illinois, Iowa, Nebraska, have lower valuations than startups in New York or Silicon Valley. So location does still matters. I know it's not supposed to, but it does.
Okay. I think this brings us to Saudi Arabia. We've spoken about it throughout this conversation, but I'd like to really focus on Saudi in the coming few years for the venture ecosystem and for the startup ecosystem and what it means for them. So there's a lot of dry powder there. There's a lot of appetite. Which one came first? So tell me a bit more about the investing trends that you've seen. And you did also recently open up an office there. So I'd like to know more about the thought process that went behind that. Were you following the venture funds, the startups, the different firms? So what really made you move there?
So we never wanted to open another office. We were going to have one office, and that's it, and that was going to cover the whole market. But we basically got enough clients in Saudi, said we should probably open an office there. And I think what they're doing there will attract more and more startups, more and more funds. But it was a very soft landing. You know, one of our clients incubated us. They gave us the office. We didn't sort of drop in from nowhere. In terms of the trends in Saudi, they're doing all the right things, like KAUST, that Taqaddam's program, sort of creating the next generation of startups to keep up with the dry powder that's actually available. I think you have 4 or 5 accelerators. So yes, the dry powder is there, but they're creating the environment to create more and more startups to qualify for the dry powder.
Okay. And from a legal perspective, tell me a bit more of how you find it different operating in different parts of the Middle East than Saudi. So because I know that the government has a lot of incentives, they've eased up so many processes. So tell us a bit more of, if I'm a company that wants to migrate to Saudi or set up a business in Saudi. So walk me very briefly through how I'm able to do that.
So if you're in the certain sectors, so some sectors like real estate, some defense, agriculture, still not open to foreigners, but that's not specific to Saudi. We have the same system in Jordan and most Arab countries. But if you're in tech and software, which is what most startups are in, the process is relatively easy. You usually have a holding company registered in the US or Cayman. You open a branch there, or you open a subsidiary. It takes about a week. I mean, it's pretty easy to do. Yeah.
Okay. So you spoke about the different sectors and what's more difficult than the other. So a main theme we've seen Saudi Arabia thriving towards is fostering local high quality production, whether it comes to its partnerships with different automotive companies to manufacture locally. We've also seen them getting inspired a lot by China's mobile first success. So you have a lot of fintech, prop tech, e-commerce, gaming developments happening there, infrastructure enhancements as well. So all of these, they've been making strides in all of these different sectors. So what do you think from a legal perspective as well? So we've seen with fintech, they have done an incredible job in consolidating all of the requirements and regulatory policies to be able to really create all of these integrated payment systems and have a very clear process for any fintech that wants to register in Saudi. So they've created the environment for that. So what next sector from a legal perspective and government perspective do you see them really approaching?
I mean, the next big one will probably be in service tech. Services, unfortunately, still very siloed. If you're an accountant in Jordan, you can't be an accountant in Saudi without waving in. But, to create that type of scale, you need to be able to just work anywhere, which is what gives startups the leg up. You create one software, you could basically sell it around the world. In terms of fintech, I know they have a sandbox. They have eased up the regulations for new fintech companies. But fintech is tough because banks are a main stakeholder in most Middle Eastern economies. So creating their competition, so the government has to walk a very fine line between allowing innovation without annoying the existing industry. I don't know how that's going to play out. In Jordan, at least, the central bank does have a sandbox. I don't think anyone uses it. Most people just incorporate outside and try their hand here.
You said something that was interesting. So an accountant in Jordan can't be an accountant in Saudi. And I was just thinking about how, so you see like the European Union and how, moving around is very easy. You can easily or with very minimal, paperwork, move and work in anywhere within the EU. So as Hisham, how do you envision this for the Middle East of building something like that, particularly maybe in the tech sector? So a developer here can easily move to Saudi and it's all under the same system.
I mean, ideally, we'd have national associations. There would be one Middle East association that qualifies all accountants, qualifies all doctors, all lawyers, right? There's just one sort of, that all the Arab countries are members of, and it allows you to be qualified in any place in the Arab world.
It makes your job much easier.
Yeah, it does. It does. Of course, existing service providers don't like that, but we work with people in Egypt, GCC, in Iraq, because our market is global, not global, maybe regional. But I think that's sort of where the trend is. I think the next trend is going to be sort of regionalizing service providers.
So I don't want to leave this episode without asking you, As Hisham, you've worked with the funds, the startups, the governments, and the banks.
Right.
So if you were to do it again, or not if you were to do it, if you were given the opportunity, which one would you be? Other than a lawyer, which one would you be?
I would probably be the startup. I like that. Fund managers, it's a tough job. You've got to raise money and you've got to find people to put that money with. You're sort of stuck in the middle. Startup, you're sort of at the forefront. You're creating. I think that's where I would like to be.
What would you think of? What startup would you think of doing? But don't tell me something that had to do with legal tech. I want to hear something that you really want to do.
It's fintech related, but there's a big gap in the market in the Middle East on these sort of very simple financial services like factoring, payday lending, accounts receivable financing. These are all very well developed in the US, but that financing segment it's not here. You can't find it anywhere. So I think something in that.
Okay, I think this wraps it up. Hisham, thank you so much for being with us here today. Thank you so much for sharing your paper. And we definitely look forward to your next releases.
Thank you.